Hello guys, it's Samuel here. Today we'll be expanding upon our last video, which was an introduction to pairs trading. We will be covering how to identify a pairs trade opportunity, along with a variety of examples. If you haven't already, be sure to watch the first video in the description below. Let's start with a brief recap of what pairs trading is. Pairs trading involves two correlated underlyings that have recently diverged. To initiate, purchase the underperforming underlying while going long an equivalent amount of the other pair. This allows for you to capitalize on a reversion to the mean with no impact if both trend up or down. Be aware that historic correlations do not guarantee future ones, and the reversion is not guaranteed. Now, how to identify such an opportunity? It is imperative that you find highly correlated underlyings that make sense to be paired together. Matching industries and revenue streams for equities often is a good qualifier. For currencies, fixed income products, and commodities, matching macro ramifications or similar supply and demand dynamics can work well. We would look for a long-standing correlation of over 0.8, and when plotting the two underlyings on a graph, we should be able to see clear similarities and some divergences with widening of the gap between lines, which we would then see is where we could place a trade. Let's look at some examples now. On the equity side, as mentioned, we need to find two companies in the same industry with similar revenue sources. General Motors and Ford are great examples in the automotive industry, JP Morgan and Wells Fargo in banking, Pepsi and Coca-Cola, and even Home Depot and Lowe's. Other paired trading examples include gold and silver, wheat, corn, and soybeans, crude oil and copper, and then a whole variety of fixed income products and spreads. These pairs do not move identically, but they tend to move together. After identifying a historical trend, we can look for a point at which they may have diverged. Could do this mathematically, but for those more visual, we can chart them to see. Let's look at some examples. So here we have General Motors with Ford in orange. And what we see is a strong correlation between the two over the past few months and even the past few years if we looked out farther. But what would we look for? We'd look for opportunities where the spread between these two lines widens drastically. That's like in April, the latter half of April. As this is quite wide, we then would go long the underperforming underlying, in this case Ford, and we'd go short General Motors. So then it doesn't matter if both of them trend up and go up 20% or go down 20%. What we're focusing on is this spread narrowing. And as we can see, just a month later, the spread completely narrows, and then we could exit the position and realize profit. Another example is JP Morgan and Wells Fargo. What we see here is during the COVID-19 pandemic in March of 2020, when the whole market was selling off, Wells Fargo got hit substantially harder than JP Morgan, as JP Morgan is seen as a stronger banking company at the moment. Wells Fargo was down over 50% when JP Morgan was down in the upper 30%. So now if we look at the past few months though, what we see is because of that relative underperformance between the two correlated pairs, Wells Fargo has actually outperformed JP Morgan. So let's say in October, we see this wide spread between the two. So if we were to go long Wells Fargo and short JP Morgan, we see that narrowing of the spread, and that's when we would realize our profits. Because we essentially we lose less money on the short side than we gain on the long side. And our risks are mitigated because if the whole industry were to go down 20% or up 20%, it wouldn't really be a focus or make a big difference. An interesting thing to note, while Wells Fargo has been outperforming the past few months due to a relative oversold, the nature of the stock the past year, basically, over earnings periods, oftentimes we play the spread between JP Morgan and Wells Fargo, or Morgan Stanley and Wells Fargo, as Wells Fargo historically does extremely poorly over earnings. And I'm not talking about whether it was a miss or a beat, but in terms of the price action and investor sentiment the following day. Versus if you look at a company like JP Morgan and Morgan Stanley, they tend to go up 70 some percent of the time after earnings are released. This past quarter was an exception, but it's worked 9 out of 10 of the last quarters. If we look at gold versus silver, so now let's look at gold and silver. We see that these two markets are correlated, and that has to do with the pair being correlated for the past 5,000 years and them both being precious metals that are typically watched. And the gold to silver ratio is tracked extremely closely by precious metal traders, and it has been for thousands of years. So this is one of the most long-standing relationships that we can look at. Because silver has the industrial input component versus gold being more of the inflationary hedge and flight to safety type of asset, there is often a divergence. What we saw most recently last November, when gold was rallying on inflationary expectations that have since continued, gold was in the upper 1900s, and silver still was in around the 26s with a gold silver ratio, I think around in the 80s. Now, historically, this ratio is far too high, and when that happens, a reversion typically tends to take place between the correlated pair. So if you were to go long silver and short gold, what you then would see is over time, when that gold silver ratio decreases, currently at around 67, which is still high, when it decreases, you profit, even with no net exposure to the long side or the short side between the correlated pair. One thing to also note is if you want to further tighten the spread between gold and silver, you can introduce a long euro component because the dollar and gold are inversely correlated. The dollar and the euro are inversely correlated, but silver and the euro aren't as correlated as one would think because of that industrial input component. So we looked at gold and silver. I noted that wheat, soybeans, and corn often move together because of the inputs and the demand dynamic between those soft agricultural commodities. And then fixed income products are also interesting to look at, whether you're comparing spreads between treasuries and corporate bonds, or if you're looking at different terms of treasury bonds and creating some type of steepener or flattener position on the yield curve. To summarize, once you identify a pair to watch that meets your qualification, watch the charts and look for opportunity. If there is a divergence and temporary reduction in correlation, look to go long the underperforming underlying and hedge with a short position on the outperforming underlying, capitalizing on the spread, narrowing. This strategy is market neutral and can be done across all asset classes and investment products. Thank you everyone for watching, and if you liked this video, make sure to like and comment what was the most interesting pair you have seen. If you have not already, make sure to subscribe and join our trading community below.